The law of supply and demand is a fundamental principle in economics that describes the relationship between the availability of a good or service, supply, and the desire or need for that good or service, demand. Essentially, it dictates that in a competitive market, the price of a product will move toward a point where the quantity demanded by consumers equals the quantity supplied by producers. This equilibrium, price and quantity, are determined by the interplay of supply and demand forces. On the supply side, producers aim to maximize their profits by supplying goods and services at a price that covers their costs while yielding a satisfactory return. As the price of a product increases, producers are typically incentivized to supply more of it, as they can earn higher profits. This relationship is often depicted graphically as an upward-sloping supply curve. On the demand side, consumers' willingness and ability to purchase a good or service determine the quantity demanded at various price levels. Generally, as the price of a product decreases, consumers are more likely to buy more of it, and as the price increases, they tend to buy less. This inverse relationship between price and quantity demanded is often illustrated as a downward-sloping demand curve. When supply and demand curves are plotted on the same graph, the point where they intersect represents the equilibrium, price and quantity in the market. At this point, the quantity demanded equals the quantity supplied, resulting in market stability. However, shifts in either supply or demand can disrupt this equilibrium, leading to changes in price and quantity. For instance, an increase in demand, perhaps due to a change in consumer preferences or an improvement in income levels, will lead to a higher equilibrium price and quantity. Conversely, a decrease in supply, such as a natural disaster affecting production, will result in a lower equilibrium quantity and higher price. Understanding the law of supply and demand is crucial for policymakers, businesses, and consumers alike. It helps predict market behavior, informs pricing strategies, and guides decision-making processes in various economic contexts. The law of supply and demand finds application in various real-world scenarios, influencing decision-making processes across industries and sectors. Here are some common applications. Pricing strategies. Businesses often use the law of supply and demand to set prices for their products or services. By understanding consumer demand and the cost of production, companies can adjust their pricing to maximize profits. For example, during periods of high demand, such as holidays or special events, businesses may raise prices to capture increased consumer willingness to pay. Market analysis. Analysts and economists use supply and demand principles to assess market conditions and forecast trends. By analyzing factors affecting supply, example, production costs, technology, regulations, and demand, example, consumer preferences, income levels, population trends, they can anticipate changes in prices and quantities traded. This information is valuable for investors, policymakers, and businesses making strategic decisions. Government policy. Governments often intervene in markets to address imbalances in supply and demand or to achieve specific social or economic goals. For instance, in response to shortages or surpluses, policymakers may implement price controls, subsidies, or taxes to stabilize prices or encourage production. Minimum wage laws and agricultural subsidies are examples of government policies influenced by the law of supply and demand. Consumer behavior. Understanding the law of supply and demand helps consumers make informed choices about purchasing goods and services. Consumers may adjust their buying behavior based on changes in prices or availability. For instance, when the price of a particular product increases, consumers may seek cheaper alternatives or reduce their consumption altogether. International trade. Supply and demand dynamics play a significant role in international trade. Countries with abundant natural resources or specialized production capabilities may have a comparative advantage, leading to differences in supply and demand patterns across borders. Trade agreements, tariffs, and exchange rates are influenced by these dynamics as governments seek to protect domestic industries or promote exports. Overall, the law of supply and demand serves as a foundational concept in economics, guiding decision-making at individual, organizational, and societal levels. Its application extends beyond theoretical models to shape everyday interactions in the marketplace.